Work with Srini Rangan of IIM Bangalore, and we're actually in the middle of two versions. So the version that was complete was is going to be changed very substantially in the second version, but I'll try and explain how the changes are going to occur. Hey, you've given me the discussants thing, I think. When we first got involved with this, we realized that the data that we have consists of compliance filings. Compliance filings are presumed to reflect honest insider trades. People wouldn't cheat and then go and report that they're cheating. So therefore, we thought that the more interesting question was, if there is, then do these honest insider trades serve some other purpose? So, for example, to begin with, can insiders make money with just reporting on the state? It's not a foregone conclusion that they benefit. Then there are some traditional questions. Do they anticipate returns? Do they make money before, during, or after the earnings announcement? Then it's when another signal, namely earnings announcements, are available. There are these two signals, information substitutes or information complements. Why did we want to study insiders? For several reasons. One, large insider trading samples for India have only recently become available. Then compliance filings presumably reflect honest insider trading, so whether that could still yield some advantage was of interest. Then unlike other kinds of informed traders, insiders who, under the legal definition are corporate insiders, have not only have hidden information, they also have capacity for hidden action. And so they can do more things. And there is this issue of whether their actions can lend credibility to words. Why focus on earnings announcements? See, in the phrase made popular by Schelling, earnings announcements are a natural focal point. While much of academic research has looked at the actual information content of an earnings announcement, namely if there is good news in the announcement, do prices go up? If there's bad news, do prices go down? Far fewer papers are focused on simply people paying attention to a particular corporation because its earnings announcement is imminent. So which means irrespective of the information content in the news, the mere fact that people are focusing more attention on that firm rather than other firms could have an impact. So this is sort of the focal point idea, and we wanted to exploit that as well. Then in recent years, there's increasingly been the notion that earnings announcements are cheap talk, which in economics is a very formal definition. It is costless in the sense of not having out-of-pocket costs, non-binding in the sense that it does not limit strategies available to the person making the disclosure, and unverifiable in the sense that it's not verifiable to a third party like a court. So which means they can say whatever they want with complete impunity. And if earnings numbers are like this, then would these insider trades, which reflect actions, help lend credibility to the earnings announcement? And just so you know, if any of you have ever encountered a course in financial statement analysis, it is customary nowadays to keep telling students that every single item in the income statement and balance sheet is a soft number, is a number that requires judgment and therefore is subject to manipulation. And when I first started saying this, I used to say, except cash. After Satyam, I said, I'm stupid, even cash. India's insider trading law, as the first speaker noted, has been superseded by a new act that has become effective as of May 2015. But our data sort of comes from well before 2015, so it's all governed by the old act. We've had an act since 1992. the definition of insider has very slowly been included to, expanded to include more connected persons. Block holders, in other words, those who hold more than 1% or who trade more than a certain percentage each year, also have to file the same reports that other corporate insiders would have to, which means in these compliance filings, you will also get large FIIs, foreign institutional investors, filing under this act. There are some differences across jurisdictions in the world relating to insider trading law. The US adopts basically an abstain or disclose rule, which means if the insider discloses his private information, he's permitted to trade. Whereas in India, there are certain periods, like around the earnings announcement, where there is a complete prohibition, and the compliance officer of a company can expand the period when there has to be a complete prohibition. The language used in the act, as the first speaker noted, is connected persons rather than related parties, means the same thing. Enforcement is difficult and patchy everywhere, not only in India. And there was a famous paper called World Price of Insider Trading by Bhattacharya and Doak, which showed that while lots of countries have beautiful insider trading laws, because with copy and paste, you can sort of copy and paste everywhere, the huge difference to cost of capital was made by whether or not the first significant conviction had been obtained. If even one significant conviction was obtained, cost of capital went down. If that was not obtained, and there were lots of countries without that, it remained high. Then over the last 30 or 40 years, there have been some 100 or 200 dissertations in the theory of regulatory capture, which is increasingly documented how the entities that the regulator is supposed to regulate capture the regulator. It occurs in the utilities, it occurs in a variety of other industries, so it's not a new hypothesis. Then some have noted that this expansion of the definition of insider to include not just sort of designated corporate insiders, but also others, has been a little slow. And there have been other sort of bits and pieces of anecdotal evidence, one big chunk of which I'll get to in a little bit, which suggests that our regulator has been a very reluctant regulator. For example, on 18th February 2005, in response to a writ petition, the Bombay High Court ordered BSC to release the same kind of data to academics that NSE was doing till that time. And SEBI was a respondent. To this day, there is a struggle to get that order implemented. Nothing has happened. Okay, now I need to switch between this and the PDF. I'm going to show you some more anecdotal evidence. If I just read out from a slide, this will have no impact. I have to show you bits and pieces of the actual original document. Only then will you appreciate the state of enforcement. Now, sort of what I've done is, there have been a long sequence of RTI queries starting from 2005 and going on till now. Much of it reflects an effort to get foreign institutional investor transaction data, which is filed with SEBI daily electronically by all the FII custodians. For a long time, they kept saying they didn't have the data, or you would ask for X, they would pretend you're asking for Y, reject it, and sort of many such things happened, till at one point, there was an appeal. It went to the Central Information Commission, and okay, if you look at this top highlighted thing, it says respondent, which means SEBI, turned down the request on grounds that the disclosure of such information would violate provisions of sections 8(1)A, D, E. Now, at this hearing, at the very beginning, they sort of smiled sheepishly and said, yeah, actually, it's not all that. The problem is we don't have the data. We have to get it from the custodians, and unless we get it from them, we can't give it to you. And for almost 2 years, I mean, they were sort of saying, we didn't have the data, or you're asking for stuff we can't give you, and things like that. And just to see what is significant is that this is not a journalist writing a story. Because a journalist writing a story, if If it's a good journalist, the journalist may have sources, but unless the sources agree to go on record, you can't find out who's saying it. And if it's a bad journalist, he might even make up sources. This is stuff that basically involves SEBI's own words in documents created by SEBI, or where SEBI was responsible for the creation of. He says clearly, look at the second highlight, this information is not with, it's not with us. Now, what is this 81ADE, which is among their favorite stuff for rejecting things? 8A is, if we disclose this stale information, market information that's more than 6 months old, it will affect the sovereignty and integrity of India, security, strategic, scientific and economic interests, blah, blah, blah. What is D? This is information that includes commercial confidence, trade secrets, intellectual property. For a while, they were actually pretending that I was asking for real-time feeds which brokers buy. And we were asking for stale data, 6 months old data. And this is not commercial confidence. All trade records are originally public records. They were in the marketplace. Everyone in the marketplace could observe them. And even though this says in the larger public interest, even if it involved commercial confidence, it could be given, that phrase was never considered. And part E, fiduciary relationship. When SEBI defines fiduciary relationship in responding to an RTI query, it sometimes goes from London to Tokyo. So it includes everything. So then, we decided to ask, who are these custodians? And then we found out they're the large banks. And it was one of the banks that told us, SEBI already has this data, and gave us SEBI's circular. So then we tried telling them, but you seem to have this data, here is this circular, and nobody took any notice. That went on for a while till another civil servant explained to us that we have to get SEBI to acknowledge its own circular. So otherwise, this will go on for years. So a friend of mine took this copy of the SEBI circular asking custodians to file every day electronically, in Oracle database format, so that it would go from the bank's computer to SEBI's computer seamlessly at 5 o'clock in the evening. He took that, he was rejected first round, and then he appealed, the first appeal. His first question, is this document, operating guidelines for reporting transactions, in fact issued by SEBI as indicated? Answer, we are not able to ascertain. This is like Bill Clinton parsing the word is. In some of you of a certain age may recall that Bill Clinton during the Lewinsky affair to parse the word is very creatively. So there is nothing going on between me and Lewinsky, and when some of his friends were also shocked and said, couldn't you be man enough to acknowledge that you made a mistake? He said, no, is can mean is and never has been. That is one meaning of is. Another meaning of is simply is. Is there anything now? I was completely truthful. So in a similar manner, this guy interprets the question as, how do I know the source of this document? You brought it, I don't know. Then let's jump to question 3. Is this version 2.2 of the guidelines still valid and in force? If no, please let me know which is the version used. It says no. New instructions were not formally communicated as they were mere changes to original procedures, which have been done through interactions with the custodians over a period of time. Are these latest guidelines currently enforced? No. So then he complained, it went to the appellate officer, and the appellate, so he told the appellate officer he did not wish to know the source of the document, in fact, where he got the document from. He wanted to know if this particular document has in fact been issued by SEBI. And on behalf of the SEBI CPIO, the Public Information Officer, they respond, it's not our job to check paragraph by paragraph. It's a 3-page circular. And he's apparently technically correct. He's not required. He's not prohibited from.
5 minutes.
5 minutes more? Wow. Okay, then let me go to, can I have 3 minutes? If the guideline is not in force, whatever is in force should be provided to him. This is where you have a gem of an answer. The current reporting mechanism is an informal arrangement under which custodians are reporting. The circular is not in force. It has, however, not been withdrawn, repealed, or superseded either. Okay, in this particular case, this was the only case where the first appeal worked in our favor. See, then to help us gain data for academic research, a member of parliament asked a question. He got garbage for an answer. He had to file a complaint. No action was taken on his complaint. And he had to file an RTI query to sort of asking them what they did about his complaint. And then SEBI started posting publicly the foreign, the FII trading data that you now see posted on SEBI's website and the Mirror website, which is NSDL or NDSL. Now that the original data with SEBI is of this form, okay, where you have the names. Now we've never asked for unmasked data. We've always asked only for masked data. But SEBI changes the mask every month, and it releases what is in table 2. So which means if you see 4 distinct IDs, you don't know whether it pertains to 4 people or 2 people. So for most practical purposes, it is useless. So we asked for stuff that would keep the names anonymous, but let us trace the history. And here they responded again. Basically, this, if you look at the last paragraph, commercial confidence, competitive position, 81DE. So basically, our regulator, who is supposed to help maintain a level playing field, argues for preserving an unlevel playing field. The SEBI's heart is not in enforcement. I mean, that is very clear. It's true even of other jurisdictions. But in the US, sometimes you will have an individual sort of judge, like Judge Rakoff, who can impose some discipline which does not otherwise exist. As we work through this, we've come to the conclusion that the more interesting question is, why do some people comply? I mean, what is really bothersome is that even low-hanging fruit is ignored. For example, simple checking of consistency between different filings is not done. Many of you might have used, this quarterly shareholding pattern data. Okay, every quarter they release those filings.
I'm really sorry. We're really running out of time.
Oh,
we're really running out of time. It's been 22.
Okay, so if most of you have the presentation, you can sort of look at that. I'll just go to the last slide. See, our goal is to check in the revision. We want to see whether the cases of clear violation of the law in the data. For example, there's a huge fraction of the data which involves people trading on the earnings announcement date. There are many cases where between the board meeting date where the financial results are accepted and the actual filing of the financial statements with the exchange, there's a gap of 7 or 8 days. So that's another naked violation. We want to check whether there are special advantages, whether insiders who trade at that time gain more than other insiders. And so we're looking at not just statistically, not just statistical significance, but also economic significance. In the long run, we think the more important question is figuring out why anybody complies, given how lax enforcement is. Thank you.
Okay. The discussant, Kiran Kumar.
Susan, for inviting me to discuss this particular paper. I'm not getting through the summarizing again what Professor Murugappa did. So what I do is just simply go through what it is. Yes, it's an interesting paper, as well as it is having good public policy interest. What is the central question that this particular paper asks is to examine the relation between insider trading and information released during the earnings announcement, and whether insider trades are motivated by the desire to make profits around earnings announcements or not, and whether and how markets use information on insider trades to modify their valuation of the unexpected earnings. So those are the central questions that this particular paper raises. And what are their key findings? Their key findings are insider trades are profitable, especially for holding for a period up to 1 year. And they also document the presence of post-earnings announcement drift. That's what they talk about in their paper. And both the signals, earnings announcement signal as well as the insider trading information signal, both when they are available, whether these signals are perceived by the investors as complementary or as a substitutes. And they found that both are neither the complementary nor the substitutes. But of course, when the negative news comes up, they act as a substitutes. That's what their major focus of the paper. And what are my comments or what are my remarks? So for my remarks, I just thought of putting down the comments in terms of the variables, how they are measured and how they are estimated, and what kind of data that they used and how it's been used, and then the empirical design or empirics, what kind of tests that they employed, and what is the methodology that they have done. So my comments are on these things so that the paper can be benefited in some way or the other. So let me get on to the ways of measuring unexpected earnings, because what they are trying to do is they are trying to see earnings announcements, the earnings result, whatever they get it. So the paper defines unexpected earnings as the difference between earnings per share in the quarter T minus from the lagged value of the 4 quarters. So 4 quarters before, because the seasonally adjusted. This difference is further scaled by the price per share on day -2. Day -2 is just before the earnings announcement, day -2. Okay? But the question here comes up, how do you control for the firms giving earnings guidance? Generally, whenever you try to look at the earnings announcement, the firms also give you some sort of, yes, the next quarter going to be very good or maybe very bad. So be aware of that. Such kind of statements also will come up. So how do you account for that kind of things? In India, there is no organized analyst forecasts are available because that particular organized analyst forecast industry is still at the very nascent stage. So what one need to resort is, one need to model this earnings on a time series approach. And there is a literature, there is huge literature which starts from the Ball and Bro 1968 suggests that there are several kinds of models are there where it said that quarterly earnings which is seasonal random walk with no drift, with AR1 model, and a seasonally moving average model. So there are several models are there, but what they do is just a simple random walk with no drift. That's what they employ. And the only paper that is available on Indian context is Kaushal Sen's Journal of Contemporary Accounting Economics Journal, where they report the post-earnings announcement drift, which is very closely related to earnings announcement or earnings surprises, what this particular paper does. They use Provis data. They also use the Provis data from the year, their sample period ends at the year 2006. So the data on the quarterly earnings essentially available. So instead of just doing a simple random walk with no drift, they can do it by using the past data. Of course, they can do some sort of time series approach or time series modeling and then try to get the earnings surprises. Because the better the earnings surprises measured, the better the results that you may obtain. Okay, so that's what it is the case. And how about this? And the next question is, on ways of measuring the unexpected earnings, still on that thing. What they do is the quarterly earnings on quarter T minus quarterly earnings on the T minus 4 quarters before. That particular difference, they divide it with the price on the day -2 of the earnings announcement. So that's what they do, the deflator. This particular deflator includes the information from quarter T and also information after the quarter T. Why so? Because typically the companies will announce the results, their quarterly earnings, almost one month after their quarter ended. So deflator includes the information such as analyst revisions, competitor earnings announcements, and hence this particular deflator creates a bias. But what one should do it, maybe using the price at the beginning or ending of the quarter T will avoid any bias. Further, dividing by the price could inflate the value of the earnings surprises when the price is low. So for the case of small set of stocks, small cap stocks, when their price is low and the earnings surprise is there, then when you divide it with the small stock price, then the earnings surprises will go up to a huge extent. And because their sample size includes the entire 1,600 firms that are listed on the NSE or NSE and BSE, so that gives you the small cap stocks, several might be there. And how about other alternative deflators? There are several other alternative deflators one can use, like total assets or book value of the equity and such kind of things. So maybe one can use such kind of deflators as well. And the next is, again, on ways of measuring the CARs, cumulative abnormal returns. What the paper does is just they look at the cumulative abnormal returns as the returns minus market excess returns. Essentially, the particular stock return minus the market return on that particular day. So that's what they define the abnormal return. But essentially, maybe what one need to do is that there is a huge literature which says that yes, one need to use the beta adjusted model, size adjusted, 3 or 4 or 5 factor form of French factors that need to be adjusted. But I don't know why the paper is silent on it's silent on why they are not used such kind of other market models or when they are defining the cumulative abnormal returns. So the bottom line is, if I need to buy the story of the paper, then the key variables, because their key variables are the earnings surprises and cumulative abnormal returns. They need to be estimated, they need to be measured accurately, then only one can get the robust results. That's about the variables measurement. And then the other is, let's look at on the data side. The figure 2 of their paper, when they are reporting the post-earnings announcement drift is there, they divided the quarterly earnings surprises into 4 quartiles, as it's been picked up from their paper. So on the horizontal axis, it is the day 0, the days after the quarterly earnings announcement has been plotted. When you see that quarterly earnings announcements, quartiles Q1, Q2, Q3, Q4, you can see that both the Q3 and Q4, which are supposed to be the higher earnings surprises, for them, even after the 40 days, which means that even after 2 months after the quarterly earnings announcement, still they are in the downtrend only. So what, only after the 40 days, or only after the 2 months after the good surprises, it goes up. So maybe that seems to be something going wrong or something going different, and the paper misses or ignores to comment on this particular feature of the graph. So maybe I was trying to look at why it is so the case, and maybe a possible explanation as well, taking the clue from their figure 1, is that insiders use the post-earnings announcement period to trade foreknowledge of the next quarter's earnings. Let's say suppose immediately the earnings announcements have come, maybe within that window period, or else maybe immediately after that window period of the moment the window period is done, maybe the insiders are trading on the foreknowledge of the next period quarters. So which is that need to be captured. As a test of this conjecture, they need to do some other tests. And literature shows the information content of insider trades vary with the type of the insider. The type of the insider can be the promoter, director, key managerial personnel, employee, immediate relative, others, and there are several insider trader categories are there. But what this particular paper does is it completely includes, at least I get the particular sense by reading the paper, it takes all the insider trader transactions and then clubbed into one. So maybe what they need to do is they need to, because the literature also suggests that yes, you need to look at the results. Say suppose for example ESOPs are the employee stock options. The guy who, whatever the insider trades are there by the employees, they may not be of much information signal may not be there. So maybe the promoters or maybe the directors or the key managerial persons, their trades may be having much more signal. Maybe they need to separate it out. And also, so the raw data need to be very clearly cleaned up before doing that such kind of analysis. Otherwise, the people, the study will get missed signals. And how about that? On the data period, their study period is 2008 to 2014. In that particular period, on an average, on the moment you look at the entire market moved up by 60%, but they report their quarterly earnings or the insider tradings, they get somewhere about negative earnings or maybe very meager small earnings or small profits. Maybe that they need to look at why exactly the case. And as well, maybe what one need to look at when they are trying to look at the quarterly earnings announcements, maybe the last quarter, the quarterly fourth quarter earnings announcement, maybe they need to exclude because as done by some of the related literature, because what generally the case is along with the year-end results, year-end means financial year end, not just particular that fourth quarter results, they'll give some other extra information also the companies will give. So if you are trying to look at only about the earnings announcement, maybe what one need to do is, maybe one can exclude just the fourth quarter and then concentrate on the remaining 3 quarters. Okay. Now, on the empirics, yes, I'm just having 2 more slides. Yeah. On empirics, yes. Empirics in the sense hypothesis, T stands in the table 5 and table 6. those are the first tables that the paper reports. They report the cumulative abnormal returns following the earnings announcements in the table 5 and insider trades in the table 6 of panel A. For significance test, the paper uses the usual t-test and Wilcoxon jet test. But what one need to do is when the cross-sectional clustering of events are there, like earnings announcements, dates, as well as the insider trade announcements are there, when there is a cross-sectional clustering is there, the standard errors will become a biased estimates. So one need to adjust their standard errors. There are several suggestions are there right from the literature from the corridor 1989 of JFE, as well as been very well implemented right from the Campbell, Wesley, JFE 1993 paper onwards. So maybe they can look at it because in the table 5 and table 6 of panel A, they don't say that what kind of standard errors they use. They just say that the simple standard errors. Whereas in the table 7 and table 8, they also say that they adjusted for some sort of robust standard errors. They used it. And the profitability of insider trades around earnings announcements in the table 6, when you look at it, they say that only for insider sales, but not for the buys. The profitability is only for the insider sales, but not the buys. But the moment when I look at the entire literature, in fact, I worked on the insider trades for a different period. So what I sensed is insider trade buy signal is much more stronger as compared to the sell signal, because sell signal might be having some sort of liquidity concerns also might be there. So you will not get the sell signal much more prominent, whereas the buy signal is much more prominent. I don't know why they get such kind of result. And even whatever the sell signal, when they say that profitability is there, they report that there is only a 6% return is there, 6% profitability is there. So are these really economically profitable? Because nowadays the savings in savings rate itself 6% statement is coming up. So we can't say that yes, insider trades are very profitable here, because one need to go account for the transaction costs and other things. So sound robustness results may be obtained if analysis is done separately for the large, mid cap or small cap, instead of clubbing all the 1,600 firms together. Maybe they'll get, because they are clubbing everything, maybe they are getting some other kinds of mixed result. So that need to be taken care of it. And then finally about the testing design. Somehow I don't like the design, whatever the design that they employed. In case if I need to do this particular design, maybe I'll do it as double sorts instead of the single sort. So first sort on the earnings surprise, then on the insider trading, which is similar to the Daniel and Titman of Journal of Finance 1997 paper that they have done. With this kind of design, what one can do is, how do the insider buys and sells vary with the earnings surprise, or how do insider buys and sells are related to the stock returns after controlling for the earnings surprise, and vice versa. So maybe a simpler or maybe a better design is this kind of approach. Anyway, so that's about my comments. Enjoyed reading the paper, and as well, it forced me to read literature on the earnings surprise, which is a new addition to me. And hope this will help the paper. Thank you.
We have 5 minutes for questions. Anyone who wants to ask questions, please raise your hand. I'll just come to you. So we have about 3 questions. Let's take all the questions and then give the answer. If I'm express the chairman's prerogative and make a few comments up front, I do think that the interlinkage between the RTI Act and the problems in implementing it, and the conclusion that insider trading is badly enforced, is a bit of a leap of faith for me, particularly as a lawyer. Okay, so I just wanted to, because a lot of elements a lot of segments in the regulatory system are broken, but that does not necessarily say that the other segments are also broken. I'll just table the comments and we'll take all and you can respond in one go. I also feel if compliant insider trades are profitable, that does not lead to a conclusion that there is a violation of law. So a compliant insider trades being profitable, and as the discussion says, if it's only yielding a return of 6%, maybe one needs to churn that data a little more to also see the non-sales part, because you can profit by holding on to a share also. It needn't only be a booked profit, it can even be book profit. You don't need to sell unless you need liquidity, is another element I thought I'll table. Yeah.
I'm actually taking a step back. What I'm saying probably may be very heretical. So we need to first analyze whether insider trading should be criminalized in the first place. Because first of all, from a legal point of view, it's a victimless crime. So just because I'm making a profit by way of insider trading, it doesn't mean somebody else is necessarily making a loss. Secondly, there's the whole point of information discovery. Because insider trading does lead to market efficiency. The point is that the currently available public information is not leading to efficient price discovery. There is this information which is out there, but it's in the hands of a few people, it's not public. But few people acting on it and trading on it are actually leading to better price discovery. Thirdly, if you do legalize insider trading, then there'll be a lot more market participants actually investing and trying to get that data. Therefore, the unfair advantage which a few people have by way of violating the law, they no longer have that unfair advantage. And lastly, as the point was just raised, I mean, even if you have very strong enforcement of insider trading laws, how do you deal with the case of insider non-trading? So you have public, you have sensitive information, but you're not trading on that basis, though you intended to. So no matter how strong your enforcement mechanisms are, you still can't capture that element of insider trading. And lastly, I think there's a huge deal of economic literature on this point. I believe Milton Friedman spoke about this quite a bit, saying that insider trading should not be banned because that actually leads to market efficiency. I had the occasion of having this discussion with Preet Bharara, who was the lawyer in the Galleon case. And his point of view was that he strongly favored having laws against insider trading because he felt it leads to market manipulation. So as long as we can distinguish between insider trading and market manipulation clearly being a wrongful practice, I'm just wondering what's the economic rationale for criminalizing insider trading?
Okay, I think those are larger philosophical questions also being tabled. You may restrict your answers to the comments on your paper. Yeah, I think there were two more questions. Yeah, Srinivas.
I had a very naive question. It looks like you went into this project with all this baggage about you're dealing with SEBI and the RTI. So which came, I mean, did you start with that or the project started? No, the question I was asking is you started with the premise that this whole regulatory structure is broken, and then you are taking some data which you clearly knew the SEBI was not enforcing or even having eyeballs on it. How do you go to the point of taking this data seriously? So, I mean, suppose let's say somebody puts out data selectively from the insider. You wouldn't even notice, right? Because the SEBI is not actually pulling up or having a system in place where, somebody gets caught because this is really either selective disclosure or something else. So I'm just wondering, from a researcher, how did you get to this?
Okay, Venkat, then Kamla.
Yeah, the paper gives me an impression that insider trading is equal to quarterly announcements, which is not the truth. Unpublished price-sensitive information is much more than only quarterly announcement. So I think that aspect has been totally ignored in the paper. That is my first impression. Secondly, the way we are measuring the monetary returns that an insider is expecting. See, an insider does his trading based on unpublished price-sensitive information with many goals. For example, if I'm a promoter, I have pledged my shares. I don't want bank to give me a margin call. The way I trade will be. The benefit, you cannot measure it in terms of monetary returns. It will be much different. So there are direct monetary benefits. There are indirect fringe benefits that people enjoy. How do you bring that into picture also is something you need to factor in.
5 minutes?
No, see, I anticipated having half an hour for the talk. I didn't realize it would be 10 minutes, which was why I got into trouble. We did not start with the assumption or with the baggage of this trying to get information out of SEBI. This was motivated by large literature on insider trading and the fact that very little has been done with Indian data. And we simply saw this as a case where two signals rather than one, and rather than treating insider trading as equivalent to earnings news, we were interested in it because it is different from earnings news. See, it reflects actions rather than news. That was the reason why we were interested in it. Now, I have to explain why I felt that a certain amount of anecdotal evidence was important, because without this, you can't get a statistical statement, based on all those anecdotes. But it helps establish context for the data. It tells you the environment in which you're gathering data. I mean, I started talking about that shareholding pattern, and then he said time up, so I didn't finish. If you try and reconcile the changes in the shareholding pattern with, the actual filings, some cases you can, many cases you can't. Now think of how many hundreds of papers have used that data. Now, even if you're sort of addressing a simple question: do cats drink milk? Okay? The way a profession works, you quickly get into finer questions. Are Indian cats different from American cats? Then, do fat cats drink, whole milk? Thin cats drink skim milk? But you must begin by making sure you have the right animal. You have a cat, you have the right beverage. And we tend not to pay attention to this, whereas our intention was to focus more on that. This entire RTI evidence and the anecdotal evidence became more important in our deciding that in the rewrite, we have to separate the obviously illegal trades or clear violations of the law, which are nevertheless being reported, versus the other trades. And it was to motivate focusing on that we went into a bit of that. Now, with respect to your question, I think the second speaker of the day will have a lot to say about why these old arguments of it being a victimless crime and nobody's. So short answer is it affects market confidence. That if some people are at an inherent disadvantage, participation in markets will become less to the extent that confidence diminishes. And that was the logic that was used to promote the insider trading. And that's about it. Okay.
Environmental element. You did say that there is no RACOF in India. There is a Securities Appellate Tribunal, which
See, I had it on a slide.
pulls up SEBI for not acting strongly enough.
Okay,
for
very
example.
good. See, I had a slide, listing a couple of appellate decisions. Now, if you read some of that...
So, no, the only suggestion is, maybe there's a bit of
let me
noise
finish,
in the
please.
paper
Let me finish.
on the RTI side, and taking that out may perhaps it'll make it a little more sonic in terms of
See, it
messaging.
seemed like a lot because I sort of had only 10 minutes. I thought I had 30 minutes. That was the reason.
25 minutes.
I don't know. Okay, but with respect to the appellate tribunal, if you read some of those rulings, okay, for example, there was a ruling with respect to Jhunjhunwala, something with respect to Satyam, Chief Financial Officer. I agree, those rulings are phenomenal till the last paragraph. I mean, you will not see such a fine example of public reasoning as you will see in some of those appellate rulings. In the last paragraph, when it comes to the penalty, it was nothing. It's like a slap on the wrist.